In the heart of America's industrial legacy, Boeing stands as a titan, its wings stretching across a century of innovation, ambition, and unapologetic grit. From crafting planes that carried presidents to powering global travel, Boeing has long been a symbol of American ingenuity, but in 2025 the company finds itself not soaring triumphantly, but clawing through a storm of geopolitical tariffs, supply chain chaos, and a brand of patriotism that feels more like punishment than pride. This is no ordinary turbulence. Boeing is navigating what it calls the most complex environment since World War II, caught between skyrocketing demand for jets, a fractured supply chain, and a political climate that seems to reward loyalty with a sledgehammer. The question isn't just whether Boeing can survive, it's whether the very idea of American industry can endure when patriotism becomes a policy that strangles progress. The story begins with a phone call, not a press conference or a diplomatic summit, but a private, high-stakes exchange between President Donald Trump and Boeing CEO Kelly Ortberg. In that breathless moment, Trump issued an ultimatum as blunt as a campaign slogan: build every plane in America or face a 200% tariff. No negotiation, no nuance, just a directive that echoed across factory floors from Wichita, Kansas to Everett, Washington. The warning wasn't abstract. It was a direct response to Boeing's quiet proposal to shift a sliver of its production to Mexico, a pragmatic move to cut costs and stabilize a supply chain battered by global demand and logistical bottlenecks. For a company facing record orders for commercial jets and defense platforms, this wasn't betrayal. It was survival. But in Washington's eyes, it was heresy. Boeing's decision to explore manufacturing abroad wasn't born of disloyalty, but of necessity. The global aviation market is ravenous. Boeing's 2025 commercial market outlook projects a staggering demand for 43,600 new aircraft over the next 2 decades, driven by explosive growth in China, Southeast Asia, and India. Airlines in these regions aren't chasing patriotic platitudes. They want affordable jets delivered on time. Yet the supply chain, a web of parts, labor, and logistics, has been stretched to its breaking point. Suppliers struggle to keep pace, costs spiral, and geopolitical tensions, particularly between the US and China, have turned trade into a battlefield. Boeing's pivot to Mexico was a calculated attempt to restore flexibility, to keep planes rolling off the line without bleeding billions. But Washington didn't see strategy, it saw defiance. Trump's tariff threat wasn't just a policy jab, it was a wrecking ball. Within days, China retaliated, ordering its domestic airlines to halt Boeing deliveries and imposing tariffs of up to 125% on US aircraft and parts. Orders worth billions froze mid-flight. Planes built for Chinese carriers, like one purpose-built for Gene Airlines, made ghostly round trips across the Pacific, returning to Seattle's hangars instead of serving passengers in Zhaosan. Factories fell silent, inventory piled up. In Wichita and Everett, communities built on Boeing's payroll felt the shockwaves. Workers' hours were cut, suppliers paused production, and engineers faced the uncertainty of a company caught in a political crossfire. This wasn't just a corporate crisis, it was a human one, with families and towns paying the price for a trade war sparked by a single phone call. Boeing, once a beacon of American pride, became a cautionary tale of what happens when patriotism turns into policy. The company that built planes for presidents was now being punished for trying to build planes people could afford. For a century, Boeing waved the American flag, its factories humming with the promise of jobs and innovation. But in 2025, that flag felt more like a noose. The 200% tariff threat wasn't about protecting workers, it was about political theater. Trump's "Build in America or Pay the Price" mantra ignored the reality of a globalized economy where competitiveness demands flexibility. Boeing's modest move to Mexico wasn't about abandoning the US, it was about staying alive in a world where airlines in Asia and Latin America are clamoring for jets faster than suppliers can deliver parts. Kelly Ortberg didn't flinch. Instead of groveling, he went public, defending Boeing's strategy as a matter of survival. "We aren't political pawns," he told stakeholders. "We're in the business of building airplanes that people can fly and airlines can afford." His words were a gauntlet thrown at the feet of Washington's posturing. Ortberg argued that global competitiveness and supply chain resilience were non-negotiable in a market where consumer demand is relentless. Bloomberg reported that he projected Boeing would hit a production rate of 38,737 MAX jets per month by mid-2025, aiming for 42 by year's end. This wasn't just a target, it was a defiance of the political explosions threatening to ground the company. The numbers tell a story of grit amid chaos. In the first quarter of 2025, Boeing delivered 130 commercial aircraft, up from 83 the previous year, driving revenue to $19.50 billion, an 18% year-over-year leap. The commercial division, though still posting a $537 million loss, showed signs of stabilization. Net orders reached 221, pushing Boeing's backlog to over 5,600 aircraft, valued between $460 billion and $545 billion. This backlog is the company's lifeline, a buffer against the estimated $500 million annual hit from tariffs. But the financials are a mixed bag. Free cash flow remained in the red at $2.3 billion, a stark improvement from last year's deeper losses but hardly a victory lap. Investors, however, saw promise, sending Boeing stock soaring after unexpected profits in core operations defied grim forecasts. This was supposed to be Boeing's turnaround year, but what turned around wasn't blockbuster financials, it was a struggle to make losses less catastrophic. The ripple effects of this trade war stretch far beyond Boeing's balance sheet. China's retaliation didn't just ground jets, it grounded dreams in manufacturing towns. In Wichita, where thousands of families depend on Boeing's factories, the halt in deliveries meant fewer shifts, tighter budgets, and a gnawing fear of layoffs. Everett's assembly lines, once a symphony of rivets and ambition, slowed to a murmur. Suppliers like Honeywell, which raised its 2025 revenue forecast by over 10% on Boeing's production ramp-up, still faced uncertainty as orders hung in limbo. The FAA, still haunted by safety scandals like the Alaska Airlines Bolt incident, warned that any push to lift Boeing's production cap of 38 jets per month would face intense scrutiny unless quality standards were bulletproof. The message was clear. Boeing's ambitions were tethered to trust, and trust was in short supply. Yet Boeing didn't fold. Instead, it pivoted. Ortberg redirected deliveries to emerging markets where demand is insatiable and political posturing is less of a concern. Southeast Asia, India, and Latin America, which Boeing's outlook predicts will drive 60% of global aircraft demand through 2044, became the company's lifeline. These regions don't care about Washington's PR stunts, they want jets that fly on time and on budget. By June 2025, Boeing had delivered 280 aircraft year-to-date, trailing Airbus's 306, but closing the gap. June alone saw 45 jets roll out, signaling a push toward the target of 38 737 MAX jets per month, with plans for 7 787s monthly by year's end and 10 by 2026. This wasn't just about moving metal, it was about sending a message to corporate America. CEOs at Apple, Ford, and Tesla began murmuring that building abroad might be worth the political heat if it meant staying competitive. Boeing's defiance became a template, global ambition over blind loyalty. But the road ahead is fraught with peril. Airbus, with over 60% of the narrow-body backlog and innovations like the A321XLR, continues to outpace Boeing in speed and ingenuity. Ryanair, a key Boeing client in Europe, hinted it might delay deliveries if tariffs inflate prices, a stark reminder that politics can cost contracts faster than competitors. Meanwhile, Boeing faces the looming challenge of next-generation aviation. GE Safran's RISE engine, promising 20% efficiency gains by the 2030s, could give Boeing breathing room, if it can rebuild trust and innovation momentum. Airbus is already gearing up to produce 75 A320neos per month by 2027, while Boeing grapples with safety caps and certification delays. The gap is narrowing, but it's still a chasm. Boeing's pivot wasn't just a strategy, it was a statement. In a world where patriotism can be weaponized, survival means moving fast, talking tough, and thinking globally. The company's first quarter performance, 130 deliveries, $19.5 billion in revenue, and a modest $31 million loss, shows progress, but it's a far cry from triumph. The commercial division's 75% revenue surge to $8.15 billion is a bright spot, but the $2.3 billion free cash flow deficit looms large. Boeing's sale of its digital portfolio, including Jeppesen, for $10.55 billion was a savvy move to pay down debt and refocus on core aerospace, but critics wonder if it's a desperate patch for tariff wounds. The company's 2024 sustainability report and its eco-demonstrator X-66 aircraft signal a commitment to carbon reduction, but sustainable aviation fuel, SAF, remains a drop in the bucket. making up just 0.3% of global jet fuel in 2024. Scaling SAF to meet the International Air Transport Association's IATA net zero goal by 2050 will cost the industry $4.7 trillion, a price airlines would rather invest in efficiency than tariff wars. This brings us to the heart of the matter. What does this brand of patriotism cost the average American? The call for Buy American sounds noble, but it's pushing prices up, contracts away, and trust into freefall. Airlines want affordable planes, not political sermons. IATA warns that meeting net zero goals will require massive investment, not trade disputes that drive up costs. Boeing's customers, like Ryanair, are already whispering about switching to Airbus or even Comac if prices spike. The irony is brutal, a policy meant to protect American industry risks, kneecapping it. Boeing's backlog of 5,600 aircraft is a lifeline, but it's fraying under the weight of tariffs and mistrust. If even Boeing, the founding father of American aviation, must go global to survive, what hope is there for smaller players, for local jobs, for communities built around these factories? The stakes are stark. Global air travel demand is projected to hit 108% of 2019 levels in 2025, growing 3.6% annually through 2044. That fuels the need for 43,600 new aircraft. Not apologies to markets hungry for reliable jets. But patriotism as policy is creating delays, dysfunction, and higher ticket prices. Airbus tightens its lead, Comac creeps into emerging markets, and customers like Ryanair openly flirt with alternatives. Boeing's rebirth depends on more than delivering planes. It demands transparency, diversified supply chains, and tangible steps toward clean aviation. After two fatal 737 MAX crashes, a mid-air door blowout in 2025, and a corporate restructuring, Boeing's credibility is on borrowed time. The company must prove it can innovate, not just survive. So did Boeing make the right choice by going global? Staying loyal to a Build in America mandate might have bankrupted the company, chaining it to a supply chain that couldn't keep up, and a political climate that punishes pragmatism. By pivoting to emerging markets and defending its global strategy, Boeing bet on competitiveness over compliance. It's a gamble that's paying off. 130 deliveries, $19.5 billion in revenue, and a narrowing loss margin show a company clawing its way back. But the real test lies ahead. Sustainability isn't just a buzzword, it's a $4.7 trillion challenge that demands real investment, not empty promises. Boeing's eco-demonstrator and SAF initiatives are steps, but they're baby steps in a marathon. The company must rebuild trust with regulators, customers, and the public, proving it can deliver safe, affordable jets without being grounded by political grandstanding. In the end, Boeing's saga is more than a corporate drama, it's a mirror held up to America's industrial soul. Patriotism sounds stirring on campaign banners, but when it costs jobs, contracts, and competitiveness, it's performance theater, not progress. Boeing's next chapter won't be written with flags or tariffs, but with bold, sustainable decisions that prove patriotism and performance can coexist. The company is limping into 2025 with better numbers but a battered reputation. Its survival depends on outpacing competitors, outsmarting politics, and outlasting skepticism. If Boeing can pull it off, it won't just save itself. It might redefine what it means to be an American company in a global world. If it fails, it risks becoming a cautionary tale, where loyalty to a slogan costs more than anyone can afford.